Before we get into the labor data, one geopolitical marker worth flagging. Tanker crossings through the Strait of Hormuz are down to 1. That's a supply side risk sitting quietly in the background while everyone's focused on rates. Here's the headline: first decline in non-farm payrolls since February. This is the number that shifts the entire cutting conversation at the Fed. Unemployment ticked up at 4.1% in July. Not alarming on its own, but paired with payrolls miss, it starts to build a picture. And here's the piece that matters the most for the inflation debate. The 3-month annualized increase in average hourly earnings eased to 2%. That's a new cycle low. Wage growth cooling is disinflationary, full stop. So the labor market so far, jobs growth is stalling, unemployment is drifting up, wage pressure is fading. On its own, that's a green light for cuts. But inflation isn't cooperating cleanly. Core goods CPI came in with the largest jump since last September. Core services also made the largest jump since May. The core PPI, stripping out food, energy, and trade, is running at 5% annualized pace over the last 3 months. That is a hot print. And drill into the internals, the portfolio management component of PPI just posted its biggest jump since February 2025. For anyone green here, portfolio management fees are basically what asset managers charge for managing money. Think mutual funds, hedge funds, wealth management shops. It's counted as a service, so it lives inside PPI's services basket, not the good side. Here's why it's not just some obscure line item. Portfolio management fees are typically charged as a percentage of assets under management, AUM. So when the stock market rallies hard, the dollar value of everyone's assets goes up, which mechanically pushes these fee revenues higher too. Even if the manager didn't change their fee rate at all. That means this specific PPI category tends to run hot whenever markets have been ripping, which they have been. So part of this hot inflation print isn't really new inflationary pressure building in the economy. It's actually the market's own gains echoing back into the data a few weeks later. Here's the full breakdown by category. What you want to notice is the spread. Some categories cooling and some running hot. It's not a uniform picture, and that's exactly why this is a hard call for the Fed. Yesterday's inline CPI and today's hotter PCE-related PPI components probably cancel each other out. Jobless claims, a leading indicator, are ticking up marginally by the shape of the trend is echoing the guns and butter period of the 1960s, which is the setup that preceded the 1970s inflation spiral. That's the historical parallel we're sitting with. So layer 2, inflation is not falling in a straight line underneath the data. The government is set to sell 30-year bonds at the highest yield since 2001, 5.23%. That's the long end of the curve telling you something different than the short end. The rolling 120-day correlation between the S&P 500 and the 10-year yield is at its most negative since October 1997. Stocks and bonds are moving opposite directions again, which changes how you think about portfolio hedging. The 60-40 diversification benefit is back, at least for now. Despite all of that, the S&P just posted its best week since April, up 3.6%, sitting at an all-time high. Now here's the flow story that doesn't get enough attention. Pension funds and insurance companies are massive structural buyers of equities. They control trillions on behalf of workers and policyholders. But unlike hedge funds or CTAs, they operate under asset allocation frameworks with real constraints. ERISA, prudence standards, solvency requirements. Right now, their equity allocations are near the highest levels since the 1999 through 2000 dot-com peak. That means one of the largest structural buyers in the market is running out of room to keep buying and could flip to a net seller in a risk-off environment. So layer 3, the bond market is pricing something different than the equity market. Correlation regimes are shifting, and historically reliable buyer base is close to maxed out. Rubner's view, NASDAQ 100 PE is arguably depressed given the earnings backdrop. His broader checklist take is that the balance of flows is shifting constructive. Earnings beating while multiples compress, leverage reset largely done, retail buying again, over $1 trillion in buyback authorization coming back online. His flag for August, the market doesn't need everyone bullish, but it needs enough incremental buyers to keep showing up. September is where seasonality and position gets harder. Wei Li's framing, this is shaping up as the year of blowout earnings growth. Q2 S&P earnings came in better than expected and by a wide margin. Headline S&P Q2 EPS growth printed a stunning 50%, but you have to back out the other income and tariff refunds to get the real number. Heavy hyperscaler capex is also inflating aggregate revenue relative to expenses. The cleaner read, average stock EPS growth is running 10 to 12%. Still solid, just not the headline number. Tech now makes up a record 37% of the S&P by weight as of July 2026, and tech versus the S&P is sitting at all-time highs, eclipsing even the prior bubble peak from 1999 to 2000. We're staying vigilant here. And here's the feel behind a lot of that tech strength. Bank of America's chart on the evolution of hyperscaler 2027-2028 capex forecasts. This capex cycle is a big part of why revenue is scaling the way it is. So layer 4, earnings are genuinely strong, but the market is getting more concentrated in a smaller number of names at valuations that rhyme with the last market bubble peak. Citibank's David Chu flags that there's still fuel to a short covering rally. Recent buying has been driven by new risk flows rather than short covering. Both Nasdaq and S&P have shown strong improvement in normal positioning, moving from mildly bearish to net long. Aggregate S&P shorts are offside, average losses approaching 4, and the outstanding short base is elevated at the 91st percentile on a 3-year basis. That's dry powder for a further upside if the market keeps going. This is the one I want you to really sit with. Positioning right now is a double-edged sword. Aggregate dealer gamma is slightly short. Above the 7,900 strike, there's a block of dealer short calls that would accelerate any further melt up. On the other side, puts are stacked well below spot in the same zone where trend following systems flip from long to short futures on a roughly 4% drawdown. For anyone new to futures, quick translation. Spot is the live index price. Futures lets traders make directional bets without dealing with option strikes or theta decay, and trend followers trade off price levels mechanically. Dealer gamma matters because when dealers are short gamma, their hedging amplifies moves instead of dampening them, buying into rallies, selling into drops. So the setup above 7,900, a push higher could force dealers to chase, accelerating the melt up. Below spot, a roughly 4% drop hits the same zone as those dealer short puts and the trend follower flip level at once. That's the dealer hedging and systematic selling potentially hitting together, turning a normal pullback into a fast one. I'm not calling direction. I'm telling you there's very little cushion on either side right now. Greed is outpricing fear in the options market right now. Call skew is sitting at multi-year highs. Translation, greed is outpricing fear in the options market right now. That's consistent with everything else we've walked through. Positioning has gotten aggressively one-sided to the upside. Zooming out to the consumer, more than 10% of 18 to 29-year-olds saw their credit card debt transition into serious delinquency this quarter. Still, the highest rate of any age cohort, which has historically been the norm, but worth tracking as a stress indicator on the younger consumer. And this last one is a behavioral signal more than a market one. Gen Z is moving money out of investing and into sports betting. 52% say they've redirected investment funds towards it, and a quarter treat it as a deliberate part of their long-term financial plan. That tells you something about risk appetite and financial literacy in the next generation. And it's worth thinking about what that means for retail flows over the next cycle. So, pulling that all together, labor is softening, inflation is not cooperating cleanly, the bond market is pricing something different than equities, a major structural buyer is close to tapped out, earnings are strong but concentrated in fewer names and stretched valuations, and options positioning has very little cushion on either side of the current range. None of these things individually say sell together, but they say stay disciplined. Know your levels, and don't confuse a strong tape with a low risk one.